Good afternoon, everyone. We are here for the webinar on discussions on recent direct tax case laws. For today's session, we have the speaker, CA Rohan Pingle sir. Before we start the session, let me introduce the chairman of Direct Tax Committee. We have with us CA Piyush Charjade sir, who has experience of 25 years. And Sir has completed his FCA DISA. Sir is having the current role. He is a senior partner in Chartered and Doshi Chartered Accountants. His firm name is. He is an expert in direct tax litigations and advisory. Sir was a member of a Central Council member of ICI from 2022 to 25, and for the second term, 25 to 29. Within ICI, Sir has served all these three pivotal standing profession. He is currently the chairman of Direct Tax Committee and a vice chairman of Expert Advisory Committee. He was a member of Working Committee of Asian Federation of Accountants. Sir is currently technical advisor on International Auditing and Assurance Standard Boards. Sir is a member of committee to study physical residence and other statutory requirements of business and SAARC countries of SAFA. So we welcome you, sir. So you gave us the opportunity where all the members get the benefit by getting the knowledge through this webinars. So Sir is on board in Wimplas Limited, Cello World, and Multibase Limited. Sir dedication is also evident in his proactive involvement in creating and sharing knowledge. He's a regular contributor to direct tax publications. His contributions to the WRC publication on Vivad Se Vishwas Scheme 2020 and his role as a reviewer on FAQ on charitable trusts. Beyond his professional perquisites, Sir is actively engaged in various trusts and in organizations where he serves as an independent director, honorary board member, honorary vice president, and trustee in different capabilities and capacities, further showcasing his commitment to social and community welfare. So, sir, we request you to share a few words on today's session and throw some light.
Thank you. Yes, thank you very much, CA Aditi Agarwal ji. Thank you very much for accepting and moderating this, and thank you for introduction also. My Vice Chairman, CA Vishnu Agarwal, who is the Vice Chairman of Direct Tax Committee, who has joined the council and who has been in last 6 months, who has done wonders. And with his support, definitely we would have come with the guidance note, our suggestions before the select committee as well as Income Tax Act is concerned. Thank you very much, Vishnu bhai, for being of a great support to this Direct Tax Committee. Pawan Kumarji, who is the Deputy Commissioner of Income Tax, TDS, and a very dear friend of our Chartered Accountant fraternity also. And thank you for joining us, who would be addressing us on today, preliminary on 194T and 194R, which is a very important subject. Dear members, please be attentive, because 194T is not only which impacts partners of the business entities, but also the partners of the professional firms like chartered accountants. And I know most of you are concerned of that. I'm sure Pavanji would be trying to address that. A very learned speaker and my dear friend CA Rohan Pingleji from Mumbai, who would be addressing on the recent direct tax case laws, who is an expert. You can watch him on various videos. He keeps on releasing videos and educating members on tax subjects. Thank you very much, Rohan Pingleji, for accepting our invitation and joining us. So as I speak today, I'm speaking from Trivandrum today, actually Thiruvananthapuram today. And there is some program of Direct Tax Committee going on, wherein a discussion is happening on tax auditors, similar to a program which was done at this very platform last Thursday. And as the direct tax is moving ahead, I believe that tax audits are moving ahead, scope is increasing, and the questions are also increasing. I'm sure by such sessions, we'll be able to resolve that. And this today has been a very auspicious day also in a way. I am known of 3 important functions because I'm in Thiruvananthapuram, and today is starting of Onam festival over here. And of course, in Maharashtra already, everywhere across India, we are celebrating Ganesh Chaturthi also. And it's also end of Paryushan festival Samansri for certain categories of Jane Sachs. So it's a very auspicious day also today, wherein we are in midst of these three very important social and the festivals which are running across India. So I wish my all best wishes to all the members. I'm sure it would be very insightful for you, and I wish also this greetings for this festival to the family members of the members. So very good afternoon to all of you, and without taking much of time, I don't want to repeat because we have been discussing. Only a short note I can tell you in regard to the our last session. A lot of questions I think so we could not address in the limited number. I and my vice chairman are discussing on that also, that whether we should have another session on tax audit. So internally we are discussing. We'll try to have one more session before 15 September also, wherein your questions are already there. If you have any other questions on tax audit, you can just write it to dtc@ici.in. Maybe appropriately in a week or 2 weeks, we'll try to address that. Those questions also will also come out with new panel also, who would be able to answer those pending questions also, plus other questions which you will escalate to us. So thank you very much, all of you, and thank you once again to Pawan Kumarji and Rohit Pingleji for joining us. Aditi, thank you very much. Over to you, Aditi.
Yes. So now let me introduce the Vice Chairman of the CPE Committee and the Direct Tax Committee, CA Vishnu Agarwal, sir.
Aditi ji, only one single one to line.
Yeah, just one line. So
Yes,
one
yes.
line says he is an amazing person, and he is always available to help us and guide us in whatever form he can be. But a small introduction, sir is having 2 decades of experience, and he has a specialization in search and survey proceedings, Binami and black money proceedings, ITAD proceedings, and income tax litigations. Sir is a renowned speaker and author. He has delivered numerous lectures on direct taxes and litigation matters. Beyond profession, Sir is engaged in social engagements and community involvement, and he is a part of various Agrawal Samaj, some Agrawal associations or organizations he's a part of, and he's always available to guide us and to support us in any way he can share his insights. So, sir, a few words from you.
Thank you, Aditi. Respected Pawan Reddy ji, the Deputy Commissioner of Income Tax, and Pawan Samir ji, and Rohan Pingle ji, and our Chairman Piyush Chhajed ji, Aditi Agarwal ji from past Chairperson, and Priya ji, our Secretary of the Direct Tax Committee. I welcome all of you in this today webinar. Today we are taking the 2 parts. First on the section 194T and R, and then we will discuss about the landmark judgment of the income tax. And today we have with us from Income Tax Department, Pawan Reddy ji and Pawan Samir ji, for discussing and the awareness of the section 194T and 194R. Sir, we will in this program is on very short notice, only 2 or 3 hour our discussion. So whenever you available, sir, we will host one full 1.5 hour program only for the section 194T and 194R, sir, for benefit of all the chartered accountant across the country, sir. Thank you, sir, for joining this program. Webinar for benefit of all the members, sir. Just I say to you, sir, before selection committee, sir, we have given more than 100 close by close suggestion, and more than 100 suggestion the select committee has accepted for the new finance bill. And from our institute also, sir, we are coming out with the new finance bill act 2025, sir. Recently we will circulate to you also, sir. And recently, sir, we have came out with all the checklist of the ITR 127, 1 and 4 checklist, sir. We have already released, and the rest of the ITR checklist we are released in the next week, sir, because so many changes that CBDT has done, sir. And for tax audit, sir, because tax audit is going on, we have also came out with the guidance note for our members, sir, for the checklist. We will also provide one copy to you also, sir. So I will not take much of the time because very short time is also. So I request Aditi madam to just introduce our Pawan Reddy ji and Pawan Samir ji for benefit of all our members.
So today's session will be taken by Pawan Reddy, sir. Let me introduce sir. Sir is an IRS officer of 2017 batch. He has experience of working in assessment, investigation and headquarters. Sir is currently posted as a DCIT TDS Mumbai. So we welcome you, and so we'll be taking the session on introduction of provisions of Section 194T. We have another co-speaker along with Pawan Reddy sir, is Pawan Samir Kumar sir, which again is an IRS officer with the same 2017 batch. Sir is also posted in DCIT Mumbai. So we welcome you all. Would request Pawan Reddy sir to guide us or to throw your knowledge on the topic on 194T.
Am I audible?
Yes, sir. Yes, sir.
Yeah. Can you see the screen, please? Hello?
Yes, sir, we can see.
Yeah. Good afternoon, everyone. Thank you, Vishnuji, Piyushji, and all other participants for giving me an opportunity to speak to all of you. This is a very primary and precursor to a full-fledged session on Section 194T. We are just trying to make you aware and introduce this newly introduced section. What is the relevance of Section 194T? Before we speak about the provisions, we want to highlight what was the necessity. So if you look at the number of partnership firms and LLPs in India, there are more than 65 lakh partnership firms and LLPs in India, out of which around 17 lakh firms and LLPs are filing returns of income. So this is a huge number. Coming to Mumbai, there are about 4 lakh partnership firms and LLPs, and about 1.28 lakh of them are filing returns of income. So considering the vast number of firms and LLPs, it is imperative that uh, the transactions which are happening through these firms and LLPs are properly captured into the tax net. So this is the brief background of why there was a need to introduce Section 194T. So prior to the introduction of Section 194T, there are certain payments which are done by partnership firms and LLPs which could not be captured through the provisions of TDS. For example, if a firm pays a commission to one of its partners, commission by its definition is covered under remuneration as per section 40B(1) of the act. So any payment of salary, bonus, commission or remuneration is collectively termed as remuneration. So because of this definition, section 194H, which governs the TDS deductibility on commission payments, it is no longer applicable to the commission payment made to the partners by partnership firm. Similarly, if you look at explanation 2 to section 15 of the act, it says that salary, bonus, commission, remuneration, etc., by whatever name called, due to or received by a partner of a firm from the firm shall not be regarded as salary for the purposes of this section. So what happens is the TDS applicability on salary is governed under 192, section 192. Because of this definition, the provisions of section 182 are no longer applicable for a salary payment by the partnership firm. So these kind of exclusions have led to certain inconsistencies in tax compliance. Some people have interpreted in different manner, and there is a possibility of potential underreporting of income by the partners of the firm. Apart from that, if the payments are being made at the end of the financial year and the tax is paid by the partner after the financial year as part of self-assessment tax, then there is a timing gap. So TDS provisions have always had made an attempt to achieve the tax collection is happening at a regular interval rather than at a one-time basis. So the tax collection happens throughout the year. The exchequer, the amount is credited to the exchequer on a regular basis. That has been the attempt of TDS provisions. So in order to achieve all these goals, Section 194T has been introduced in Finance Act 2024, and this section is applicable with effect from 1st April 2025. It is not from AY 25-26. It is from 1st April 24-25. So Section 194T I've just mentioned here for reference. Any person being a firm responsible for paying any sum in the nature of salary, remuneration, commission, bonus, or interest to a partner of the firm shall, at the time of credit of such sum to the account of the partner or at the time of payment thereof, whichever is earlier, shall deduct income tax thereon at the rate of 10%. Clause 2 says, no deduction shall be made under subsection 1 where such sum or the aggregate of such sums credited or paid or likely to be credited or paid to the partner of the firm does not exceed 20,000 rupees. So we will understand them in a simple manner. So what are the nature of payments covered? Be it salary, be it remuneration, be it commission, bonus, or interest. Any of these payments, if they are being made to the partner of the firm, and if the amount exceeds more than 20,000 per year in aggregate, then TDS has to be deducted. And the Act is very clear that it is not the individual. Suppose if the commission is 15,000, salary is 1 lakh, then I will not deduct on commission. It is not like that. So you have to take an aggregate, and the TDS has to be deducted on the aggregate sum. And what are the applicable rates? The TDS has to be deducted at the rate of 10%. And first, you have to determine whether the payment exceeds 20,000 rupees per year or not. If it is exceeding, then the tax deduction should be at the rate of 10%. And timing. So the TDS has to be deducted at the time of credit of the amount or at the time of payment, whichever is earlier, right? Like any other regular TDS deduction provisions. There are certain questions in people's mind whether it is applicable to LLPs, since it says partner. So as per section 223(1) of the Act, firm shall have the meaning assigned to it in the Indian Partnership Act 1932 and shall include a liability partnership as defined in LLP Act 2008. So this is very much applicable to LLPs also. Further, partner has been defined in section 223(2), wherein it is also mentioned about partners of LLP Act 2008 as well. So, so the provisions of section 194T are applicable to LLPs as well. Another question that comes to mind is whether it is applicable to non-residents. Yes, plain reading does not differentiate between a partner who is a resident and a non-resident. So irrespective of their residential status, section 194T is applicable. CBDT has amended Form 27Q, wherein it has inserted 194T in the form. So this indicates that section 194T shall apply to non-resident partners as well. This was amended through notification 22 of 2025. So this clarifies that section 184T is applicable to non-residents as well. Another question which comes to mind is whether it applies to working partners as well. The distinction between working partner and a non-working partner is relevant only for the allowance of reduction under section 40B. The distinction is not relevant for 194T. TDS has to be deducted whether it is paid to a working partner or a non-working partner. Similarly, whether the interest amount is allowable or disallowable under section 40B is not relevant for TDS applicability. Now, let us understand the applicability of TDS provisions under 194T through an example. Suppose a firm ABC company makes a payment to partner X. The TDS liability towards various payments is as under. Suppose 15,000 rupees is paid as commission on 1st July. The cumulative amount is 15,000. Since the amount is less than the threshold of 20,000 rupees, the TDS need not be deducted on this amount. And on 1st October, if another 15,000 rupees is paid as bonus, then the cumulative amount for the year is 30,000, more than 20,000, the threshold limit. So 10% of the amount. So 33,000 rupees should be deducted. Similarly, on 1st January, if another 20,000 rupees is paid, the cumulative amount is 50,000. So TDS, another 2,000 rupees TDS has to be deducted because 3,000 has already been deducted. So for the entire year, how much is the amount paid? That 10% of that amount should be deducted as TDS. Now I request my colleague Pawan Samir to introduce you to the provisions of Section 194R. Thank you.
Respected friends and distinguished members of ICAI, so it is my privilege to get an opportunity to interact with you on the provisions of Section 194R of the Act. So this section has been introduced by Finance Act 2022 and it is applicable from July 1st, 22. The purpose of bringing such specific provision is to target the benefits of perquisites arising from business or profession which are often not reported by recipients. So a specific section was introduced from July 1st, 2022 in order to track the benefits and perquisites which are arising from business or profession to various residents and to see that they are appropriately reported in their income tax return. The threshold for the applicability of the provisions is kicked in when the total amount of benefit or perquisite provided exceeds 20,000 rupees, and in such scenario, the TDS has to be deducted at a rate of 10%. So, in order to provide more further clarity on the provisions of Section 194R, certain provision has been made authorizing CBDT to issue guidelines for the removal of difficulties and clarify the provisions. Accordingly, CBDT has issued guidelines via Circular Number 12 of 2022, dated 16th June 22. So let us briefly discuss the scope of Section 194R, the intention of 194R, the various provisions that flow from 194R, as well as the clarity that has been given by CBDT via the circular, which we have recently discussed. So for every section in the for every TDS section in the Income Tax Act, basically the Act imposes certain obligation for deduction of TDS on persons. So the obligation is conditional on the nature of payment. It kicks in when there is a threshold, when the amount that has been paid exceeds a particular threshold, and there are also certain exceptions and relaxations given inside the Act. So with respect to 194R, any person who is providing any perquisite or benefit to a resident is the person who is responsible for deduction of the tax. The applicability of the provision is from 1st July 2022. The obligation for deduction of TDS comes into picture only when the value of such perquisite or benefit exceeds 20,000 rupees. There are certain exemptions provided inside the Act, that is, when there is an individual or a HUF with turnover less than 1 crore or a professional with turnover less than 50 lakhs. For such persons, even though they are disbursing a benefit or a perquisite, such TDS obligation does not arise. So when the core point here comes to understanding what is a benefit, what is a perquisite. So benefit or a perquisite can be directly paid in cash, can be in kind, can be partly in cash, and can be partly in kind. Also, it is interesting to note that the benefit or perquisite can be in the form of a revenue receipt or a capital receipt. This Section 194R does not distinguish between a capital or a revenue receipt when it comes to a benefit or perquisites. So more often, what can be the nature of this benefit or perquisites? For example, there is a doctor. A doctor is provided certain conference fees, sponsored trips, cars, or electronic devices like phones, gadgets, etc. by the pharma company. Or let us say there is a huge multinational company or even a large distributor. For example, let us say Pidilite. Pidilite is providing annual trips, annual tours to its distributors. Or a pharma company is providing certain perquisites in the form of a gold coin or something to its authorized stockists and super stockists. So all these are benefits which are being extended to the pharma agents, to the stockists, to the distributors in lieu of the association business association with such companies. So all these can be considered as benefits or perquisites which are being provided to them by the respective companies. So we have already discussed what is the rate on which the TDS has to be deducted, which is around 10%. And the threshold is more than rupees 20,000 per recipient per financial year. It can be provided both in cash, kind, or a mixture of both. So here one important aspect is there is no need that the receipt should be taxable in the hands of the person receiving the benefit. It is irrespective of such taxability, the benefit or perquisite is considered and TDS has to be deducted. So how do we value the value of the benefit or perquisite being provided? Generally, when we say about valuation, we talk about fair market value by excluding GST from the valuation process. If if a good has been purchased, then the fair market value is considered as the purchase price. If it is manufactured and provided free of cost to any recipient, then the fair market value is taken as the price at which it is sold to regular customers. Actually, this section is a very nuanced section because it tries to capture the various sort of business interactions which we generally do not which we generally do not track in with respect to income tax purposes. So let us say some company has hired a social media influencer in order to provide some publicity to their product. So a product is given to them. Let us say I am a mobile phone company owner and I have given my product to a social media influencer for publicity. So in case the product is taken back by me after his let us say influence campaign or whatever, then the product is not considered as a benefit or a perquisite provided to the influencer. If I let the product stay with him, in such case the fair market value of the product becomes the value of perk or benefit in the hands of the recipient. Similarly, there are different sorts of scenarios. So in order to provide further clarity on all these types of scenarios, CBDT has come forward with a circular which deals case by case on various types of benefits that have been provided by a company to a recipient and categorizes them and discusses them whether it falls under the ambit of Section 194R of the Act or not. So basically, any, for example, some business conference is conducted and or some training is provided. So that is not considered as a benefit. However, if the family is also provided the travel, provided stay, provided any other leisure activity, the fair market value of such is considered as a benefit or a perquisite. Similarly, sales incentives which are given for Diwali, like sometimes even we see companies coming forward and giving cars to their distributors, TVs, electronic gadgets, gold coins, etc. The fair market value of all these things is considered as a benefit or a perquisite in the hands of the recipient, and the TDS is to be deducted by the company which is disbursing these benefits. Similarly, medical samples which are given to doctors by various pharma companies are also falling under the ambit of Section 194R of the Act, and TDS has to be deducted. So once the TDS has to be deducted, the objective of this TDS is two parts. Firstly, it is to ensure that in the quarter in which the benefit or perquisite is provided, the TDS should be deducted so that the taxation tracking of that particular transaction is available with the department. And secondly, it is also to see that the persons who are receiving these perquisites or benefits should report them accurately in their income tax returns. Recently, a survey has been conducted by TDS Mumbai in the case of Lupin, which is a well-known pharma company. So, in that particular survey action, the point of interest has been the Section 194R of the Act. So, many sorts of benefits which are being provided, monetary as well as non-monetary benefits, which are being provided by the pharma companies, not only to doctors but also to the stockists, super stockists, etc., attract the provisions of Section 194R of the Act. This 194R of the Act is attracted when the cumulative value of the benefit exceeds ₹20,000. So it is essential that clearly the data has to be maintained in the books of accounts in such a way where the tracking of the amount has to be done. For that, the fair market valuation of the benefit that is being provided has to be mentioned, and books have to be maintained in such a way that it becomes easy for the company in order to do 194R compliance. So whatever benefits are provided to the employee by the company is taxed under 192. It is not taxed under 194R. So as we know, there is a section called Section 17(2) where perquisites flowing to employees are taxed. The purpose of 194R is to track and tax those benefits or purposes which are outside the employer relationship. So the commercial discounts, rebates, etc., whatever we are being providing to the customers are also the ambit of 194R. So certain case studies we have tried to explain, but however, I am sure that the circular of the CBDT on 16th June 2022 is more elaborate with respect to these particular, cases and applicabilities of Section 194R. For example, pharma company distributes samples to the doctor. So these samples which are provided by pharma company to the doctor are within the ambit of Section 194R, and TDS has to be deducted. Similarly, let us say a corporate company with a large presence of distributors across the country provides its dealers, let us say Ultratech Cement, provides its dealers with a car as a Diwali gift. This attracts the ambit of Section 194R, and TDS at the rate of 10% has to be deducted. Similarly, an influencer on YouTube is providing publicity to a particular good manufactured by a company. So if the good is received back by the company and the cost of the good exceeds 20,000, then 10% TDS has to be deducted by the company. So basically, the Section 194R is a very nuanced provision, and it is applicable in a wide range of circumstances. So given the legislative intent of the government to bring forward this provision, it is of utmost importance to understand the intent, to maintain the books in such a way, and also to follow the provisions of Section 194R in a more holistic manner in order to comply with the TDS provisions. This is a small introduction about 194R. I request all of you to kindly create awareness about this section so that necessary compliance is made by all the concerned stakeholders. Thank you very much.
Both the sessions were very informative, and this will give a knowledge to the members that 194T and 194R perquisites benefits where the TDS provisions are to be followed in any organization or the CAs who are dealing with their clients. It's a very good section where more knowledge and deeper understanding is required as far as, because this was a introduction given by Pawan, both the Pawan sirs. So as Vishnu sir said, we will be taking the whole day session of yours, sir, where the members can ask their practical questions when they really do, and the practical difficulties they face. So it will be a more fruitful session. But yes, awareness has to be created on this section 194T and again 194R. Moving further, let me introduce the today's session speaker, CA Rohan Pingle sir. Rohan Pingle sir will be discussing on the recent direct tax case laws. So sir is a seasoned practicing chartered accountant and a partner at Motilal and Associates LLP, bringing with him over 20 years of rich professional experience. He is a very qualified chartered accountant and also completed his certificate course on concurrent audits of bank. Over the years, sir has been providing quality professional services in diverse areas like internal audit, due diligence, statutory and tax audit, direct and indirect taxation, certification and accounting, outsourcing, registration under tax laws, drafting of deeds, and the various laws. Beyond his professional practice, Pingle sir is a wide reader and thought leader, having published 75 plus articles on Tax Guru and authored 10 plus books on motivation and spirituality available on Amazon. He has also shared his insights and learning through his blog, Live Like a Monk, and his YouTube channel, CA Rohan R. Pingle, where he regularly shares learnings from the Srimad Bhagavad Gita. His other interests includes anchoring a weekly YouTube series on the Tax Guru channel under the title GST Relearn and What Law Says, along with being a lyricist with 5 plus published songs, a poet, showcasing his versatility and passion beyond the accounting profession. So we welcome you on today's webinar. Would like you to take the session, and reading your profile makes me feel that I should join your series and I should watch your YouTube channels. It will be a good thing on everyone, all the members' part. We will be get the knowledge on spiritual thinkings also, and the GST relearn, and the title also so interesting, what law says. So sir, we will definitely will be subscribing your channel also. Now would request sir to take the session on recent direct tax case laws.
Am I audible?
Yes sir.
Okay. Hare Krishna. It is an immense pleasure to address our esteemed members of ICAI and also non-members who have attended this session. Thank you so much to our Central Council member and Chairman of Direct Tax Committee, CA Shri Praful Chached sir, for giving me this opportunity. I hope I will give justice to this webinar. Also, thank you so much to Central Council member and Vice Chairman of Direct Tax Committee, CA Shri Vishnu Kumar Agarwal sir, for his opening remarks. And thank you so much to CA Aditi Agarwal for moderating today's session. Also, Pawan Kumar Reddy, DCIT sir, and Pawan Samir, who have addressed us today on section 194T and 194R. And before starting the session, I also want to express my gratitude to my principal and Guru CA Rajendra Y. Padde sir, with whom I was associated for more than 20 years before starting my independent practice last year. Whatever I am doing today is his blessings and support. So now let me allow to share my screen. Hope screen is visible. So today we are discussing recent direct tax case laws reported to ITAT and High Court. First part, we will see cases reported to ITAT, and then in a second part, we will see cases reported to High Court. And at the end of the session, also we will see one-liner conclusions that can be drawn from today's discussion. So let's begin. Today's first case, Jivanagani Films versus JCIT, ITA number 382, Mumbai Tribunal 2025, assessment year 2015-16, and date of order is 6th March 2025. Relevant section is sections 269 SS and 271D. Let's understand facts and issue of the case. The assessee, a partnership firm active in film production, distribution, and one minute. And related services engaged a vendor referred to Messrs. R. For the financial year 14-15, the assessee obtained 15 lakh loan from an NBFC. Instead of receiving the amount directly, the non-banking financial companies disburse it straight to Messrs. R via banking channels. Separately, the assessee paid rupees 10 lakh to the same vendor from its own funds. The firm recorded the NBFC loan of rupees 15 lakh as a journal entry in its books, acknowledging the liability. During penalty proceedings under section 271D, assessing officer treated this liability entry as contravention of section 269 SS, which prohibits accepting loans otherwise than by prescribed banking modes, and levied a penalty of rupees 15 lakh. Issue was, does a loan recognized via journal entry but disbursed through banking channels fall under the prohibition of section 269 SS? Let's see what tribunal observed and held. There was no dispute over the 15 lakh loan was disbursed through proper banking channels and confirmed by both NBFC and the vendor. The assessee had a genuine liability and recorded the loan via journal entry. The tribunal emphasized that Section 269 SS is designed to prevent cash-based loan or deposit transactions. Its scope is limited to actual acceptance of money and doesn't extend to mere book entries that record only liability. So the tribunal held that the transaction was outside the purview of Section 269 SS since no cash or other prohibited mode of acceptance occurred. It was a journal entry acknowledging an obligation. Consequently, the imposition of penalty under Section 271D was invalid and the appeal was allowed in favor of the assessee. Next is Deepak Parmar versus ITO, ITA number 178, 2024. Relevant assessment year is assessment year 2017-80. Date of order 19th November 2024 and relevant section is section 69A. Let's understand facts and issue. The assessee Deepak Parmar filed his return for AY 1718 declaring income of rupees approximately 2,78,000. During the year, he paid rupees 6,16,000 in cash towards credit card dues held with RBL, SBI and Citibank. The assessing officer issued show cause and statutory notices seeking explanation for the source of cash payments. The assessee failed to respond to any notices from the AO and CIT appeals. Here, what is important, we need to respond. Assessee failed to respond to any notices from the AO and CIT appeals. The AO added 6,16,000 as unexplained cash under Section 69A and applied the penal tax under Section 115 BBE. The CIT appeal confirmed the addition for lack of compliance and reasoning. It is important, lack of compliance and reasoning. Let's see what tribunal observed and held. The assessee made cash payments totaling rupees 6,16,000 for credit card bills. No explanation, documentation or replies were filed at any stage. This is what important. They have not provided any explanation, documentation or replies also. Section 69A triggers where an assessee is an owner of unexplained money and fails to satisfactorily explain its source. So it is important to explain whenever we received any notice from the department, we have to respond it. That is more important. Since the assessee didn't provide any explanation, Section 69A was correctly invoked. The tribunal upheld both the AO and CIT appeals order. It dismissed the appeal, confirming the addition of rupees 6,16,000 as income under Section 69A and the taxability under 115 BBE. Next, JK Associate versus ITO, ITA number 1200, Ahmedabad 2024. Relevant assessment year is assessment year 2017-18. Date of order 5th December 2024. Relevant sections are section 68 and 69A. Let's understand facts and issue. Assessee, a partnership firm, had not filed its return for assessment year 17-18. AO reopened the assessment under section 147 based on information that the firm purchased immovable property worth rupees 1 crore in financial year 16-17. In assessment under section 147, read with section 144B, AO added rupees 1 crore as unexplained investment under section 68 and 69A, treating contributions toward the property acquisition as unexplained capital. Issue was whether capital contributions made by partners, backed by their confirmations and genuineness, can be treated as unexplained investment under section 68 and 69 in the hands of the firm. Very interesting. Let's see what tribunal observed and held. The firm produced detailed confirmations and records showing the capital contributions of 12 partners. Firm what produced detailed confirmations and records. It is also important. We need to have detailed confirmations and record keeping from our end. ITAT held that once the partner's identity, genuineness, creditworthiness, and the mode of fund introduction were satisfactorily proved, the onus on assessee stood discharged. If the AO doubted the source, any addition should be made in the hands of individual partners and not the firm. This principle aligns with established jurisprudence that section 68 or 69A additions cannot be sustained once credibility of creditors or contributors is established. That is where the importance of confirmation is there. The tribunal allowed the appeal, setting aside the ₹1 crore addition in the hands of the firm. Specifically, it ruled that contributions by partners duly supported by confirmations and proof cannot be treated as unexplained investments under section 68 and 69A when proper documentation exists. Importance of the documentation. Next, Vishwanath Prasad versus CIT Appeals ITA number 163 to 166, Patna 2023. Relevant assessment year is 2017-18 to 2020-21. Date of order 29th August 2024. Relevant sections section 270A and 270AA. Let's understand facts and issue. The cases pertain to 4 assessment years following a search action at the assessee's premises. For assessment year 17-18, the assessee filed a return under section 139 subsection 1 declaring an income of rupees approximately 8,35,000. After the search notice under section 153A, he filed a revised return declaring rupees 13,97,000. The assessing officer completed the assessment under section 153A based on the revised return and imposed penalty under section 270A, citing under reporting of income. The assessee made a belated application under section 270AA seeking immunity from the penalty, which the AO rejected without providing any hearing. Let's see what tribunal observed and held. The tribunal noted that once the revised and assessed incomes are the same, no underreporting arises under section 270A subsection 2. When revised and assessed incomes are the same, then no underreporting arises. It also emphasized the procedural lapses. AO neither granted hearing nor passed any order on the immunity application under section 270AA within the statutory period. The tribunal allowed the appeals for all 4 years, deleted the penalty under section 270A since there was no underreporting, returned and assessed income matched. Very important, means returned and assessed income if matched, then there will be no underreporting. Granted immunity under section 270AA as immunity conditions were met and AO failed in statutory duty to hear and reject the application timely. Next, Vijayane Durai Raj, Vijayane Velud Ju versus ITO 2024, 625 ITA number 1457 of 2024. Relevant assessment year 17-18. Date of order 4th December 2024 and relevant section is section 54F. Let's understand facts and issue of the case. The assessee sold an immovable property during the relevant year and received part of the sale consideration in cash, subsequently depositing it into both his and his wife's bank accounts. What? Assessee sold an immovable property during the relevant year and received a part of the sale consideration in cash, subsequently deposited it into both his and his wife's bank account. He purchased new residential property, not in his own name, but in wife's name, using part of those proceeds. He claimed capital gains exemption under section 54F despite the new property being in his wife's name. The AO disallowed the exemption on the ground that the property was not purchased in the name of the assessee. Let's see what tribunal observed and held. Both the assessee and wife were assessed under a notice under section 148, her return accepted by the AO. The AO's concern regarding the property purchased in the wife's name didn't impair the eligibility for section 54F exemption. The tribunal allowed the appeal and directed the AO to grant the full exemption under section 54F. If you see the section 54F provision, it nowhere tells us that you need to purchase that property in own name. You can purchase it in wife's name. The purchase of new residential property in the wife's name is permissible for section 54 exemption. What is important is your investment, your purchase. The intention to invest the sale proceeds in specified asset is what matters, not the registered ownership of the new property. So it was in favor of the assessee. Next, KM Educational and Rural Development Trust versus ITO 2024 617 ITA number 1326 of 2024. The relevant assessment year is assessment year 1819 and date of order is 4th December 2024. Relevant sections are section 12A, 12AA and 139 subsection 4A. Let's understand facts and issue. The trust, a charitable institution registered under section 12A and 12AA, filed its income tax return late, but within the extended time allowed under section 139 subsection 4A. Despite timely filing in accordance with section 139 4A, the CPC-AO denied the exemption under section 11 on the ground that the return was belated. And the issue under consideration was whether the trust eligibility for exemption under section 11 is lost if the return is filed within the time allowed by section 139 subsection 4A, even though it is technically belated. Let's see what tribunal observed and held. The tribunal relied on relevant CBDT circulars clarifying that for trust registered under section 12A or 12AA, a return filed within the time limit set by section 139 4A is sufficiently valid, and such late filing doesn't disqualify the trust from claiming exemption under section 11. The AO's interpretation conflicted with the statutory objective of section 139 4A and circular guidance. The assessing officer is not entitled to deny the exemption under section 11 if the return is filed within the extended corridor of section 139 4A. The appeal was therefore allowed. The tribunal held that the trust is entitled to claim exemption under section 11 as it filed its return within the extended time allowed by section 139 4A, and such filing meets the legal requirements. Very interesting. Next, Aruva Foundation versus CIT ITA number 398 and 399, Indore of 2024, relevant assessment year not applicable. Date of order is 11th December 2024 and relevant sections are section 2 subsection 15, section 11 subsection 4A, section 13 subsection 8, section 12AB and section 80G. Let's understand facts and issue of the case. Aruva Foundation was incorporated under section 8 of the Companies Act 2013, aiming to sell and market products developed by weaker social sections. It received provisional registration under section 12AB, charitable purpose registration, and 80G, donation deduction. The foundation later applied for final registration under both the sections. The CIT exemption denied the final registration on the ground argued that the memorandum of association showed commercial intent, that is trading activities. Also refused ATG approval, stating denied under 12AB automatically disqualified it. Further claimed the ATG application was filed late. Let's understand what was the issue. Whether the presence of commercial activities or objectives in the foundation's charter, that is the memorandum, allowed CIT exemption to deny final registration under Section 12AB, and additionally, whether rejecting 12AB registration necessarily leads to rejection of ATG approval too. Let's see what tribunal observed and held. Section 2, subsection 15, charitable purpose definition, tolerates commercial activities up to 20% of total operations. It tolerates commercial activities up to 20% of total operations. Section 11, subsection 4A permits charitables to undertake business activity if conditions are met. Section 13, subsection 8 states exemption denial applies only for the specific year the commercial ceiling is breached, not for registration under 12AB. Very important. What did section 13, subsection 8 states? Exemption denial applies only for the specific year the commercial ceiling is breached and not for a registration under 12AB. Even if commercial objectives exist, CIT exemption cannot deny registration under Section 12AB. Registration can only be denied when actual activities breach the allowed limits in a given year. The foundation had engaged solely in charitable operations. No commercial activity had yet commenced. The tribunal emphasized the CIT's jurisdictions at 12AB stage doesn't extend to speculating on future activities or potential breaches. Means tribunal emphasizes what the CIT's, whatever CIT's jurisdiction is up to 12AB stage, doesn't extend to speculating on the future activities or potential breaches. Any assessment or commercial activity exceeding limits must happen through the assessing officer during annual assessments. The tribunal directed CIT exemption to grant final registration under Section 12AB to assessee, since a fresh application was filed within the extended deadline, extended till 30th June 2024 at that time. The tribunal remitted the matter back for proper reconsideration. Next, ITO versus Shri Bake Vihari Infracon Private Limited, 2024, 115 ITR T223, Raipur Tribunal, ITA number 95, relevant assessment year 2013-14, and date of order was 18th March 2024, and relevant section 68. Let's understand facts and issue of the case. The assessee company Shri Bake Vihari Infracom Private Limited reportedly received significant amount of its bank accounts which the assessing officer characterized as unexplained cash credit. The AO contended that these deposits claimed by the assessee as share capital or share premium were not bona fide and thus assessable as income under Section 68. Consequently, the AO invoked Section 68 to add these amounts to the taxable income of the assessee. Issue was whether the amounts received by the company and held in bank accounts can be treated as legitimate share capital or share premium, or whether they must be regarded as unexplained cash credits liable to be taxed under Section 68. Let's see what tribunal observed and held. The tribunal emphasized that for amounts to be accepted as share capital or premium, appropriate documentary evidence must be provided, and such as board resolutions for allotment, share application forms and allotment letters, certified copies of share certificates, and records of share application money receipts. These are the important documents to substantiate your documentary evidence. The AO must also verify that share certificates were duly issued and that the share capital was truly received and reflected in the company's records. A mere entry in bank statements without supporting documentation is insufficient to establish the genuineness of the transaction. So very important to understand. Means we only not need to have a bank entry, bank statement entry. We need that important documents with us to claim our whatever we are claiming. Means the documentation part is very much important and necessary to claim and defend our case. The tribunal held that the assessee failed to provide adequate evidence or justification to establish that the credits were genuine share capital or premium. Accordingly, the tribunal upheld the AO's addition under Section 68, confirming the treatment of the amounts as unexplained cash credits, because the company had not maintained that documentation, whatever documentation required for that particular thing. Next, Bando India Private Limited versus DCIT 2024 114 ITR 275 Delhi Tribunal ITA number 7743 of 2028. Relevant assessment year is 2014-15. Date of order 11th June 2024 and relevant section is section 43A. Let's understand facts and issue of the case. The assessee Bando India Private Limited reported foreign exchange fluctuation losses in its profit and loss account in line with accounting standards, but no actual remittance or payment was made. They reported foreign exchange fluctuation losses in their P&L in line with also accounting standards, but no actual remittance or payment was made. The assessing officer invoked section 43A, treating the paper loss as disallowable. That is the paper loss because they are documented only on the premise that no real financial outflow had occurred. Issue was whether section 43A, which deals with exchange gains or losses on specified foreign currency liabilities, applies to unrealized accounting losses that are not backed by actual payment or remittance. Very interesting and important. Let's see what tribunal observed and held. Section 43A pertains to actual foreign exchange fluctuation on the basis of real foreign currency liabilities or assets. Section 43 pertains to actual foreign exchange fluctuation on the basis of real foreign currency liabilities or assets. Mere accounting entries, that is book entries, without any real outflow or remittance do not qualify under Section 43A. Compliance with relevant accounting standards to record such fluctuations doesn't trigger Section 43A unless the transaction is real. The tribunal held that unrealized exchange loss merely recorded to meet accounting norms cannot be disallowed under Section 43A. Consequently, the addition made by the assessing officer under Section 43A was deleted and the matter decided in favor of the assessee. Very, very interesting and important. So, they cannot disallowed under Section 43A. Next, ACIT versus T. Viggiani Realty Private Limited. Relevant assessment year is 1819. IT 2025 Mumbai Tribunal, date of order 25th January 2025 and relevant section is section 36 subsection 1 and clause 3. Let's understand facts and issue of the case. The assessee engaged in real estate, borrowed funds during 1819, that is assessment year 1819. The company claimed deduction under section 36 subsection 1 clause 3 for interest paid on this borrowed capital as revenue expenditure. The AO treated the interest claim as disallowable. Why? Reasoning that the borrowed capital was advanced to sister concerns or remained unused for business purposes, thereby severing connection to the businesses. issue was whether the interest paid on borrowed capital remains deductible under Section 36, subsection 1, clause 3, when the funds are advanced to whom related or sister entities or not directly applied to the assessee's own business operations. Let's see what tribunal observed and held. Funds borrowed and lent to sister concern can still be considered as used for business purposes provided there is commercial expediency and the sister entities deploy that funds in active business. This is what important. Even though you are advancing to your sister concern, what is important is that it should be for business purpose and commercial expediency, and the sister entities deploy that funds in your own business, that is in activity. Where both interest-free and borrowed funds coexist, the prima facie assumption is that interest-free funds are used first. Thus, disallowance of interest only arises if incontrovertible evidence shows that interest-bearing funds were used first for non-business purposes. Means it must be used for the business purposes. The tribunal emphasized that so long as borrowed funds are deployed in the business ecosystem, as in acquisition of stock and trade or real estate projects in given case, interest deductions cannot be denied merely on indirect deployment via sister concern. So the tribunal allowed the assessee's claim under Section 36, subsection 1, clause 3. It held that there was sufficient commercial expediencies in advancing funds to sister concern in given case. The interest-bearing capital was part of the business cycle, even if not directly held or used by the assessee. Presumption favored utilization of interest-free funds first unless rebutted. Therefore, the deduction claimed was legitimate and the disallowance by the AO was deleted in favor of the assessee. Next, Johnson & Johnson Private Limited versus DCIT. Relevant assessment year is assessment year 11-12. ITAT 2025, Mumbai Tribunal, date of order 10th February 2025, and relevant sections are section 2, subsection 11, section 32, and section 50. Let's understand facts and issue of the case. The assessee engaged in pharma company, pharma manufacturing and sales, sold two trademarks, Coldren and Raricap, during the previous year relevant to assessment year 11-12. They are sold two trademarks, Coldren and Raricap. The trademarks were acquired on 29th July 1992 and 16th March 1998. The assessee claimed the full cost of acquisition as a deduction in their respective years of purchase and offered the sale proceeds under long-term capital gains. Next, Rabin Arup Mukherjee versus ITO International Tax ITA number 588 Mumbai Tribunal 2024 relevant assessment years 2016 and 17 date of order 21st March 2025 relevant section is 56 subsection 2 clause 7. Let's understand facts and issue of the case. The assessee, a non-resident individual received a flat in Worli, Mumbai as a gift from Ms. Viday Mukherjee via a registered gift deed dated 21st January 2016. Assessee was a non-resident individual, received a flat in Worli as a gift from Ms. Viday Mukherjee via registered gift deed dated 21st January 2016. The deed described the donor and donee as sister and brother respectively. The deed described donor and donee as sister and brother. The assessing officer held that relationship was between step siblings, not natural siblings, and thus not within the legal definition of relative under section 56 subsection 2 clause 7. Very interesting and important. What AO held that the relationship was between step siblings, not natural siblings, and therefore it is not within the legal definition of a relative. Consequently, AO reopened the assessment under section 147 and added rupees 7.5 crore to the assessor's income. Issue was whether a gift from a step sister to a step brother qualify as a gift from a relative under section 56 subsection 2 clause 7, thereby making it exempt from taxation. Let's see what tribunal observed and held. The term relative under clause E, to explanation to section 56 subsection 2 clause 7 includes brother or sister, which the tribunal interpreted to include step siblings based on common law principles and dictionary definition recognize affinity. Black's Law Dictionary defines relative to include those connected by affinity, that is marriage ties, not just consanguinity. Other statute, that is Income Tax Act, Section 2, subsection 15B, RBI Act, Companies Act, recognized step sibling as relatives. Means other act also recognize step siblings as relatives. Therefore, the tribunal concluded that a gift from stepsister to stepbrother falls within the definition of relative. Therefore, the property transfer in given case was exempt under section 56, subsection 2, clause 7, and 7.5 crore addition was deleted. The appeal was allowed and all objections to reopening under section 148 were rendered academic. Next, Shivani Bhasin Sajdeva versus Assessment Unit ITA number 3218 Mumbai Tribunal 2024. Relevant assessment year is assessment year 2021-22. Date of order is 21st January 2025 and relevant section is section 48. Let's understand facts and issue. The assessee sold an immovable property for rupees 15 crore and claimed capital gains by deducting rupees 9.96 crore, that is a cost of acquisition, and 2.47 crore as a cost of improvement. AO questioned the 2.47 crore, that is improvement claim, pointing out that flat was purchased on 27th December 2017, but the improvement agreement was dated 31st May 2010, allegedly before ownership existed. So improvement agreement was unregistered, leading AO to disallow the entire 2.47 crore. Very interesting and important. CIT appeals upheld the disallowance. The assessee appealed to the tribunal. issue was whether the unregistered agreement payments made prior to receiving the possession but in compliance with the improvement contract are allowable as cost of improvement under section 48 or not. What was the issue? That unregistered agreement payments made prior to receiving the possession but in compliance with the improvement contract are allowable as a cost of improvement under section 48 or not. Let's see what tribunal observed and held. The tribunal analyzed the agreement of 31st May 2010, noting detailed specifications for civil and electrical fit-outs and found that payments were actually incurred for improvement work. It accepted the assessee took possession on 31st March 2014 and completed improvements by then, which were integral to the property's value. So AO's assumption that improvements couldn't be undertaken before purchase was factually incorrect. Means AO's assumption was that improvement couldn't be undertaken before the possession was factually incorrect. So despite being unregistered, such agreements are not fatal for claiming improvement cost. Actual expenditure and linkage to the property value matter most. That is the main and important thing. The tribunal allowed the deduction of 2.47 crore towards the cost of improvement and directed AO to recompute the capital gains accordingly. Very important and interesting. Means it is in favor of the assessee. Means improvement cost even before taking any possession is allowable to the assessee as a deduction. So now we are moving our second part. Now cases reported to High Court. In this case, we will discuss directly what will be the issue and what High Court held the decision. So we are not discussing facts directly. We will see what was the issue in that case and what was the decision of High Court. So first case, Associated Chambers of Commerce and Industry of India versus DCIT 2020-5473 ITR 696 Delhi High Court. Relevant assessment year is assessment year 1617. Date of order 5th August 2024. And relevant sections are section 11, subsection 2, section 147 and section 148A. Let's see what was the issue. Whether the assessing officer could initiate reassessment proceedings under section 147 or 148, read with 148A, and deny exemption under section 11 subsection 2 solely due to late digital submission of Form 10, that is accumulation plan of the trust, especially when no portion of the accumulated income actually escaped the assessment. What was the issue? That whether AO could initiate reassessment proceedings under section 147, 148, read with 148A, and deny exemption under section 11 subsection 2 solely due to what? Late digital submission of Form 10, that is accumulation plan by the trust, especially when no portion of the accumulated income actually escaped the assessment. Let's see what Delhi High Court observed and held. Section 11, subsection 2, clause A requires the trust to furnish a statement in Form 10 detailing accumulation purposes and mode. What? Trust to furnish. Furnish. This is a procedural requirement, not a condition precedent for claiming exemption under section 11, subsection 2. It is only a procedural requirement to furnish a statement and not a condition precedent for claiming the exemption under section 11, subsection 2. The digital portal for Form 10 was introduced only in financial year 15-16. Circular number 7 of 2018 acknowledged genuine difficulties faced by trust in timely digital uploading. The delay in electronic filing without dispute on genuineness of the accumulation cannot transform into the taxable escapement. it is very important. Means we see whenever any updates or any modification in technology, we face a number of technical defects for technical difficulties while filing our returns or forms. So it is like that. The case is that the Form 10 is unable to upload digitally because what? There are the technical difficulties faced by trust in timely uploading the digitally Form 10. So therefore, the delay in electronic filing without dispute on genuineness of the accumulation cannot transform into a taxable escapement. The assessment order dated 1st December 2018 had already accepted what the accumulation under Section 11 subsection 2. Thus, AOs believe that income except assessment lacked any factual basis and could not justify reassessment under Section 147. So AO didn't adhere to Section 148A's requirement to provide a proper show cause notice and consider objections before issuing a reassessment notice, rendering the process procedurally invalid. The High Court quashed both the reassessment notices and the order under Section 147 and 148. It ruled that delay in digital submission of Form 10 doesn't warrant reopening where the accumulation under Section 11 subsection 2 was accepted in the original assessment. The delay was due to procedural or electronic transition issues. No taxable income had escaped the assessment, and the AO failed to comply with mandatory 148 hearing and objection process. Next, ESS Singapore branch versus DCIT 2025 473 ITR 541. Delhi High Court relevant assessment year is 2014-15 and date of order is 22nd August 2024. Relevant sections are section 199, 240 and 244. Let's see what was the issue. Whether upon an appellate order in favor of the assessee, the assessing officer could restrict TDS credit to the amount originally claimed in the return, ignoring higher actual TDS deposited. Very important and interesting. Proceed to compute the refund based only on claim TDS in return, despite higher credits reflected in Form 26A. Determine interest and refund eligibility under Section 199, 240 and 244 of the Income Tax Act 1961. So let's see what Delhi High Court observed and held. A very interesting issue. What means assessee have not claimed TDS return, but Form 26A's credit is there for that particular TDS which assessee had not claimed. So very interesting. Section 199, what Delhi High Court observed and held, Section 199 unequally treats TDS deposited as tax paid. Once tax is deducted and booked, once tax is deducted and booked and is used, once tax is deducted and booked in Form 26A, the assessee is entitled to credit even if not claimed in return. Please note down, very important, what Section 199 is what TDS deposited as tax paid. Once tax is deducted and booked in Form 26A, the assessee is entitled to credit even if not claimed in the return. Where refund arises from a non-revenue court's order, the refund must be granted automatically without requiring a separate claim. Interest becomes due from the beginning of the relevant assessment year until actual pay refund date. The AO's action in relying on a limited TDS claim in the return is misaligned with the legal mandate and contrary to the tribunal's directions and statutory provisions. What High Court hail is that AO's action in relying on a limited TDS claim in the return is misaligned with the legal mandate and contrary to the tribunal's directions and statutory provisions. The High Court quashed the AO's order. It directed the AO to acknowledge the entire TDS deposited as per Form 26AS under Section 199 and grant refund automatically under Section 240 without requiring an application, pay interest from 1st April of AY 1415 until the refund receipt under Section 244A. Next, Principal CIT versus Milia Tracon Private Limited 2025-473 ITR 155 Calcutta High Court block period 1st April 1996 to 7th May 2002 date of order 3rd July 2024 and relevant sections are sections 132 and 158 BD. Let's see what was the issue. Whether proceedings under section 158 BD, that is block assessment of undisclosed income, can be validly initiated against a non-search person on the basis of a satisfaction note, only a satisfaction note, and seized materials without. A satisfaction note recorded by the AO who conducted the search under section 132 and proper handover of seized books or documents to the AO of the non-search person. What was the issue? Issue was proceedings under section 158 BD can be validly initiated against a non-search person on the basis of satisfaction note and seized materials without a satisfaction note recorded by the AO who conducted the search under section 132. Means AO conducted the search but without having a satisfaction note and proper handover of seized books or documents to the AO of the non-search person. Let's see what Calcutta High Court observed and held. Section 158 BD requires that AO who conducted the search must record satisfaction that undisclosed income relates to another person and hand over seized materials to the relevant AO of the non-search entity. Whenever "and" is used, it is should be read as a cumulative. Means both need to be satisfied. Here "or" is not used. What is used is "and." Section 158 BD requires that AO who had conducted the search must record satisfaction that undisclosed income relates to another person and hand over seized materials to the relevant AO of the non-search entity. In this case, the satisfaction note was recorded by the AO of the non-search entity, not by the searching AO. Means satisfaction note was recorded by the AO of the non-search entity and not by the searching AO. Further, no proper handover of documents occurred, both being essential steps for valid proceedings. Both being essential steps for valid proceedings. The tribunal and High Court held that initiating block assessments without satisfying these statutory prerequisites renders the proceedings completely without jurisdiction and hence void ab initio. The High Court dismissed the revenues appeal, affirming the tribunal's decision. Next, Northern Arc Investment Manager Private Limited versus Deputy DIT 2025-472 ITR 154 Madras High Court, date of order 10th November 2023 and relevant section is section 143. Let's see what was the issue. Whether in faceless assessment and faceless assessments under section 143 subsection 1, the AO or CPC NFSC must intimate any corrections, additions or reductions made in the assessed income to the assessee and provide the assessee a real opportunity to respond before finalizing the intimation. What was the issue? Issue was whether the faceless assessments under section 143 subsection 1, the AO must intimate any corrections, additions or reductions made in the assessed income to the assessee and provide the assessee a real opportunity to respond before finalizing the intimation. Let's see what Madras High Court observed and held. Subsection 1 allows the department to process returns and make corrections. Process returns and make corrections. However, any such changes require mandatory intimation to the assessee along with an opportunity to respond. Once the assessee is given notice of corrections, their response must be fully considered by the AO before issuing any final assessment order or intimation. Even in faceless assessments, procedural fairness, notably prior notice and meaningful consideration of rebuttals is non-negotiable, means it must be necessary even it is a faceless assessment. So the Madras High Court directed that the department must allow the assessee to file a reply to any corrections before issuing the final intimation under section 143 subsection 1. If the reply is filed, the AO must consider it and recalibrate the intimation accordingly. The petition filed by Northern Arc Investment Merger Private Limited, that is assessee, was allowed, granting permission to file a rectification petition to address the double disallowance error and process the refund. Next, Incredible Unique Build On Private Limited versus ITO 2024-470 ITR 106 Delhi High Court. Relevant assessment year is assessment year 11-12. Date of order 3rd November 2023, and relevant section is section 205. Let's understand what was the issue of the case. Whether when tax has been deducted at source by the payer but not deposited with the government, the assessee, that is the deductee, can be compelled to pay the amount or be denied TDS credit, especially in the absence of Form 16A as per Section 205 of the Income Tax Act. Very interesting and important case. Whether when tax has been deducted by the payer but not deposited with the government treasury, and the assessee, deductee, can be compelled to pay that amount again or to be denied TDS credit, especially in the absence of Form 16A as per Section 205 of the Income Tax Act. Let's see what Delhi High Court observed and held. Once it is established that tax has been deducted at source, Section 205 prohibits any recovery from the deductee as self-assessment tax, even if the deductor failed to deposit the tax in government treasury. It is irrelevant whether Form 16A was issued or not. It is very, very, very important. Means once we have established that TDS has been deducted, Section 205 prohibits any recovery from the deductee as self-assessment tax, even if the deductor failed to deposit the tax in government treasury. It is irrelevant whether Form 16A was issued or not. While Form 16A is one form of evidence, it is not mandatory. Other reliable materials like written disclosures, ledger statements, and complaints to the department can sufficiently demonstrate the existence of TDS. The payment of TDS is the responsibility of whom? Deductor. The deductee cannot be penalized or held liable for non-deposit by the payer. Means we can relate to it GST provision in ITC. Means whenever ITC denied on when the collector not deposit his GST to the government treasury. So we can relate it to under that, means provisions like this or case laws like this are required under that also. So it is straight away whenever, even though deductor is failed to deposit it in the government treasury, but TDS is deducted, the deductee have a right to claim the his DDS. So the payment of DDS is the responsibility of the deductor. The deductee cannot penalized or held liable for non-deposit by the payer. Next case, Mrs. Usha Ishwar versus ITO and ORS 2024 470 ITR 200, Bombay High Court, relevant assessment years 97-98 to 2000-2001. Date of order 7th July 2023. Relevant sections are section 147, 148, 245R and 245S. Let's see what was the issue. Whether reassessment can be initiated after the 4-year limitation based on an advance ruling given in a different case. What was the issue? Whether reassessment can be initiated after 4-year limitation based on an advance ruling given in even though on a different case. If the taxpayer followed an AR ruling, can the department reopen assessment for other years without change in law or new factual material? This was the second issue. If the taxpayer followed an AR ruling, can department reopen assessment for other years without a change in law or new factual material? Let's see what Bombay High Court observed and held. Binding nature of advance rulings under section 245R, 245S, and AR ruling is binding on the assessee, jurisdictional AO, and only in respect of the transactions covered, unless there is a change in law or facts. Means AR ruling is binding only on the assessee, the jurisdictional AO, and only in respect of the transaction covered, unless there is a change in law or facts. No new material or change in law, then the AO sought to reopen assessments only because a subsequent AR decision in another case had taken a different view. The High Court held that this didn't constitute new tangible material or change in law. Means if you want to reopen, you need to have a new tangible material or change in law. Nor did it pertain to the specific assessee's transaction. So AO sought to reopen assessments only because a subsequent AR decision in another case had taken a different view. The High Court held that this didn't constitute any new tangible material or change in law, nor did it pertain to the specific assessee's transactions. Violation of time limit and fair process. Since the original assessments were beyond 4 years and all reopening conditions were unmet, the notices under section 147, 148 were invalid. The process also bypassed section 245R, 245S safeguards. The Bombay High Court quashed the reassessment notices and orders and issued under section 147, 148. It ruled that reliance on another's applicant's ruling without a fresh material or legal change cannot justify reopening, especially post 4-year threshold. Next, Mohammed C. AK versus ACIT 2025 472 ITR 161 Kerala High Court, relevant assessment years 2020-21 to 2023-24. Date of order 11th March 2024 and relevant sections are section 132A, 147, 148 and 148A. Let's see what was issued. Whether the initiation of reassessment proceedings based on materials seized under section 132A was valid when the assessee challenged the manner of seizure and retention of documents under section 451 of the Code of Criminal Procedure, and whether notices under section 148 and 148A were sustainable in law for particular assessment years. Let's see what Kerala High Court observed and held. The power under section 132A to requisition and retain seized documents must be exercised strictly in accordance with the statutory requirements, and any breach renders such seizure unlawful. Retention of documents beyond permitted time frames without proper approval violates procedural safeguards, giving the assessee the right to seek relief under Section 451 of the Code of Criminal Procedure for interim custody. The new reassessment regime post Finance Act 2021 mandates strict compliance with Section 148A procedures, including providing adequate opportunity to the assessee before issuing a notice under Section 148. Any reassessment based on unlawful written documents or without adherence to the Section 148 is vitiated. Is you need to retain a lawful documents. You need to have a lawful documents with you. Means the assessing officer. The Kerala High Court held that reassessment notices under Sections 148 and 148A invalid as there were predicted on documents requestioned and retained contrary to Section 132A and criminal procedure safeguards, directed the revenue to release the said documents to the assessee under Section 451 unless valid retention orders were produced. The proceedings for assessment years 2020-21 and 2023-24 were quashed with liberty to the revenue to initiate fresh proceedings after curing the procedural defects and following the due process under Section 148A. Next, Manjula D. Rita and Bhavya D. Rita versus Principal CIT 2025 472 ITR 116 Bombay High Court, and relevant assessment year is 2012-13, date of order 19th June 2023, and relevant sections are Section 179 and 264. Let's understand issue of the case. Whether the Principal Commissioner of Income Tax, Principal Commissioner of Income Tax was justified in upholding the recovery proceedings under Section 179 of the Income Tax Act against the petitioners, being the directors of the private company, for company's outstanding tax liabilities, despite their claim that the company had ceased operations and the directors were not in control of the company's finances. Also, whether the revision under Section 264 could be invoked to grant the relief. Very important case law. Whether the Principal Commissioner was justified in upholding the recovery proceedings under Section 179 of the IT Act against the petitioners, being the directors of a private limited company, for company's outstanding tax liabilities, despite their claim that the company had ceased operations and the directors were not in control of the company's finances. And another issue was whether revision under Section 264 could be invoked to grant relief. Let's see what Bombay High Court observed and held. Section 179 empowers the revenue to recover tax dues of a private company from its directors only if the tax cannot be recovered from the company and it is established that such non-recovery is due to the director's gross neglect, misfeasance, or breach of duty. Both the conditions need to be satisfied. It has to be, means if company from it cannot be recovered from company and it is established that such non-recovery is due to the director's gross neglect, misfeasance, or breach of duty, then only you can initiate actions against director. The onus lies on the revenue to prove that the director was responsible for the company's inability to pay its taxes. Mere status as a director doesn't automatically result in liability. Very important. In exercising revisional powers under Section 264, the Principal CIT must act judicially, especially where the directors demonstrate the absence of personal fault or show that the company's financial collapse was beyond their control. In exercising revisional powers under Section 264, the Principal CIT must act judicially, especially where the directors demonstrate absence of personal fault or show that the company's financial collapse was beyond their control. So the Bombay High Court quashed the recovery proceedings under Section 179, holding that the revenue failed to establish the petitioner's gross neglect or breach of duty leading to non-payment of the company's taxes, directed the principal CIT to grant the appropriate relief under Section 264, considering the petitioner's case on merits and the fact that the tax recovery could not be solely shifted to directors without evidence of culpability. Emphasize that the liability under Section 179 is not automatic and cannot be fastened when statutory conditions are clearly satisfied. Next, National Association of Software and Services Companies, NASSCOM versus DCIT exemption 2024 470 ITR 493, Delhi High Court, relevant assessment year 2018-19, date of order 1st March 2024, and relevant sections are sections 154, section 220, subsection 6, and section 237. Let's understand issue of the case. Whether NASSCOM, a charitable organization, was entitled to seek rectification of an intimation and refund under Section 237 of the Act, and to claim protection from coercive recovery under Section 220, subsection 6, when the assessing officer rejected its Section 154 application despite admitting an apparent error in computation of income. Let's see what Delhi High Court observed and held. Section 154 permits rectification only of mistakes apparent from the record. Section 154 permits rectification when only mistakes apparent from the record and when the error in income computation is undisputed and arithmetical, the assessing officer is bound to correct it. Section 220 subsection 6 is a discretionary but equitable power. Recovery proceedings should ordinarily be stayed when the assessee's claim is prima facie meritorious and the demand is under challenge. Refund under Section 237 is substantive right where taxes paid exceed the lawful liability. Denial solely due to pendency of appeal or unwillingness to rectify is arbitrary. Delhi High Court directed the AO to rectify the mistake under Section 154 and issue refund under Section 237 with applicable interest. Order that no coercive recovery steps be taken against NASSCOM under Section 220, subsection 6, till final disposal of the matter. Emphasize that charitable bodies cannot be subject to unlawful recovery or denied legitimate refunds merely due to administrative reluctance. Hemant Mahipatra Shah versus Anand Upadhyay 2025 482 ITR 1 Bombay High Court. Relevant assessment years are 2012-13 to 2018-19. Date of order 12th August 2024, and relevant sections are Section 2, subsection 35, Clause B, Section 201, Section 221, Section 276B, Section 278B, and Section 279, subsection 1. And this is last case for the today's discussion. After that, we will move to the one-liner conclusions. Let's see what was the issue under the case. Whether prosecution and penalty proceedings under Section 276B, 278B, and Section 279, subsection 1 for failure to deposit TDS could be validly initiated against the assessee designated as a principal officer under Section 2, subsection 35, Clause B, when the company had already faced demand and penalty under Section 201 and 221, and whether such simultaneous actions were legally sustainable. Very interesting. What was the issue? Whether prosecution and penalty proceedings under section 276B, 278B, and 279 subsection 1 for failure to deposit TDS could be validly initiated against the assessee that is designated as a principal officer under section 2 subsection 35 clause B when the company had also already faced the demand and penalty under section 201 and 221, and whether such simultaneous actions were legally sustainable. Let's see what Bombay High Court observed and held. The designation of a person as a principal officer under section 2 subsection 35 clause B is not automatic. The revenue must demonstrate active responsibility for financial management and decision making leading to the TDS default. Means it is not automatic. The principal officer under section 235 clause B is not automatic. The revenue must demonstrate what active responsibility for financial mismanagement. Recovery and penalty under section 201 and 221 are civil liabilities. Prosecution under section 276B and 278B is criminal in nature and cannot be pursued mechanically without establishing mens rea, that is guilty intent. Section 279 subsection 1 requires proper sanction before prosecution. Mere existence of a TDS default, or earlier penalties doesn't justify automatic prosecution. Simultaneous civil and criminal actions must not result in double jeopardy unless statutory conditions are met and clear evidence exists of deliberate default. Very important and interesting. The Bombay High Court quashed the criminal prosecution initiated against the assessee, that is Hemant Shah, holding that the revenue failed to establish his role as a principal officer. If it established the role as a principal officer, then the case may be against the assessee. But what revenue failed to establish his role as a principal officer responsible for the TDS defaults and failed to prove mens rea required for prosecution, and therefore it is in favor of the assessee. Clarified that while demand and penalty under section 201 and 221 could stand, separate prosecutions under section 276B and 278B cannot be sustained without specific sanction and evidence of willful default. Means specific sanction is also required along with the evidence of willful default. Both need to be satisfied. Directed that any future prosecution must follow due process under section 279 subsection 1 and be based on independent findings rather than mere presumption of liability. So that's it for today, and now we are moving to one-liner conclusions that can be drawn from the cases discussed today. Let's see. First, journal entries reflecting. So we will be reviewing our discussions today in a one-liner conclusions. Hope it will be benefited for all of you. Journal entries reflecting loan liability without cash transfer do not violate section 269 SS. Penalty under section 271D not sustainable. Unexplained cash payments for credit card bills without substantiating source rightly attract what addition under section 69A. Partner's capital contribution, when substantiated, cannot be taxed as unexplained income in the firm's hands under section 68-69A. Interest disallowance under section 36 subsection 1 clause 3 cannot stand when the assessee demonstrates sufficient interest-free funds. No underreporting exists when revised and assessed income both match. Immunity under section 270AA must be granted. Exemption under section 54F is allowable even if the new house is purchased in spouse name. Return filed under extended deadline of section 139(4)(a) is valid for claiming exemption under section 11. Registration under Section 12AB cannot be denied solely due to commercial objectives if actual charitable activity is ongoing and within permissible limits. Unsubstantiated share capital receipts can be taxed as unexplained cash credits under Section 68. Is we need to substantiate those capital receipt if you don't want to taxed under Section 68. Unrealized foreign exchange losses without actual remittance do not attract disallowance under Section 43A. Interest on borrowed funds is deductible under Section 36, subsection 1, clause 3, if backed by commercial expediency, even when advanced to sister concerns. Section 50 doesn't apply to sale of intangible assets acquired prior to 1st April 1998 that were never part of a depreciable block. Gifts from step siblings are exempt under Section 56, subsection 2, clause 7, as step siblings qualify as relative. Unregistered but substantiated expenditure for property improvements, that is, improvement cost, is allowable as a cost of improvement under Section 48. Reassessment based solely on delayed e-filing Form 10 is invalid when accumulation is otherwise accepted. TDS credit must be granted for entire tax deposited regardless of amount claimed in the return of income. Refund with interest is mandatory. Block assessment under Section 158 BD is void without proper satisfaction by the search AO and document transfer. Faceless assessment under Section 143 subsection 1 must consider assessee's response to the proposed corrections. Section 205 prohibits recovery from assessee once TDS is deducted, even if not deposited by the deductor. Reassessment is invalid when issues were conclusively settled by the Settlement Commission under Section 245R and 245S. Reassessment notices based on unlawfully seized documents and without following Section 148 procedure were invalid and quash. Directors cannot be made liable for company tax dues under Section 179 without proof of gross neglect or breach of duty. Rectification of errors and refunds must be granted to charitable entities and coercive recovery stayed when prima facie claims exist. Prosecution for TDS defaults cannot be sustained without proof of willful default, proper sanction, and clear role as principal officer. And that's it for today. Thank you so much for patient hearing. And my concluding remark would be, whenever you are handling any litigation, always read that relevant section. Means even if you know that particular section very well, but what is important is that the interpretation of the section is depend on case-to-case basis. So you need to read that section again and again. This is my concluding remark. Thank you so much. Over to you, Aditi.
So the session was really fruitful. If the viewers or the members were listening to this webinar, they must have definitely gained some knowledge as I'm practicing in Bhavnagar. So I could relate the practical difficulties I'm facing in Bhavnagar. Every point you discussed was so relevant, whether it was TDS, income tax, 269 ST, 148, and the case laws discussed by you was completely relevant. It will be definitely beneficial to the members for sure. Because the way you sum up and you presented, it was so precise, and one can get in a gist what is the matter, what will be the conclusion. So members don't have to read the whole case laws or the whole presentation, but it was really amazing. And definitely, I asked the tech team, ki I also need the presentation, because the way you have sum up the conclusions of each and every case law, that is also, sir, relevant and very useful for the members. So it's a very beautiful session organized by Direct Tax Committee. We really feel enlightened that we have such good members with us who
Thank you.
share the case laws in such a simple and a beautiful way. So we had a great session where you discussed the recent case laws. And sir, what topics you discussed are actually the burning issues or the day-to-day problems or the matters which the CA professionals are facing in their professional life or the working when they come across with. So we have few questions
Okay.
from the members. So I would like to share a few questions and to ask, so what is your
Okay. Let me try. Yes.
yeah.
Definitely.
So the question is not that relevant, but as you said, 205 section. So Shayad, probably this might help. The question is, some of the purchases will are treated as bogus purchases. 100% additions in assessment order. Recently, Bombay High Court delivered that bogus purchases can be added at 100% only. Any favorable judgment thereon? So what is your say on this? Because as you already talked about 205.
Yes. Yes.
Yes, so the further enlightenment on this in relation to the GST and how it can be betterly done in GST provisions or
I think we need to see the case-to-case basis, na? I can't comment directly on it.
correct.
Exactly
Yes, sir.
what is the case.
But a general, as you already said in the presentation only. So what is your further enlightenment on this thing, bogus purchases? Because you said it is on the collector.
But whenever we defend our case, we need to see that whether actually it is defendable or not. That is very, very important, na?
Okay.
That we need to see actually. If it is a bogus purchase completely, so how can we also defend it on
So that department says it is a bogus purchase. That is also to be proved. But yes, again,
then we need to substantiate our stand also, no? If it is not a bogus purchase, we need to defend in that way. It is whether means it is not a bogus purchase. If it is so.
Sir, one question was from Gurgaon. He says he's Sanjeev's CA Sanjeev. So his question was, my TDS from FDR interest was not deposited by the company, which has gone bankrupt. As per the incredible unique Buildcom case, as cited in this webinar, the income tax department cannot recover TDS from me. However, the demand has been raised by the department under 143(1), and my objection of the acceptance of demand has been rejected. How to get the demand out of my way?
Okay, we that actually need to see now how to apply again. It is now it is online everything. So I think we need whether he responded on online also. I don't know whether means against the 143(1). When response need to be submitted.
Correct.
And then rejection, whether he received any order or something against that response, then again we need to respond over online or something, either trace it to say officer also, the relevant jurisdictional officer also.
Correct. He can write a letter to the relevant jurisdiction officer.
Right. What is means last communication from the department.
Right. This is also regarding the non-receipt of the TDS by the deductor, though 16A is available, there will be no entry in 26A. How to claim the TDS in those cases in a faceless assessment? So when
that is also actually it is not reflected in 26A, but now you can see also in AIS maybe the AIS annual information statement is also nowadays important more than 26A.
Correct, sir.
So need to case basis we have to see.
From Mumbai, Sailesh Shalvi has asked, Section 279B prosecution for TGS default is very, very harsh and only remedy is compoundable. How do we tackle with client to convince?
It is completely depends on case to case basis. We cannot say a one line answer to it again. So we need to see what is the case actually, facts of the case.
So these were the few questions, and further I want to ask, sir, if for example, if the TDS demands are standing since so long, since more than from 2010 or 11, the TDS demands are standing in the books of accounts, and the assessee also doesn't know what for it is standing. Now the TDS department started sending the notices to the relevant assessees that these demands are standing. So how to overcome, because now beyond 6 years you cannot rectify, and the problem is that people doesn't know what for the demand is standing. There is the practical difficulty what the clients are facing. So what is the solution to that? Because department also don't know what is the real matter to that, and assessee, because maybe probably their senior, it's first generation or second generation used to handle. So how to resolve such matters? Now online correction is also not possible.
Online, if it is a physical, if it is allowable as a physical, you need to meet the concerned officer. And already department has raised the notices, then they know what is the why demand they are raising. So we need to go in deep that and meet that particular officer and also see the provisions, means what why demand is there and whatever the facts we have, because whatever we are defending only on whatever facts we have. If
Correct.
assessee also don't have the records, and if let's see the provision for the time lapse is there, means more than 10 years elapsed, then we have to defend that case on that basis, means whether the demand is right for that means more than 10 plus years, so
So
whether it is
whether
correct.
might be there must be some technical error of lower
No, it
TCS
might be
certificates or anything that was not updated that time, and people.
correct,
So this
absolutely,
might happen.
yes.
So any further questions? I could not see. But there are, if Pawan sir is there in the session, I think they left now, I guess. Yes, he's not there. But Preeti ma'am, if you want to ask, she's also not there. So another question, please highlight case law of registration under section 12A. So you have already mentioned, I believe.
But if I can on email also, no, we will revert back on email if
Okay.
they want actually.
So, and many of the members have asked your presentation, especially the concluding remarks.
Okay.
So, I think just allow me a minute. I have to ask Piyush sir and Vishnu sir.
Yes.
Yes, sir. Hello.